Hello and welcome to the final market update for 2022. I say final, it's very likely to be the final. I can't imagine that it won't be the final. You never know, I suppose, but I'll say final episode of Market Update. And today is the 23rd of December. It is my last day in the office. I'm going to be heading out here shortly. Before I get into the top three things and a bit of a wrap up of the year and markets, and for that matter, some anticipatory thoughts around next year, I want to say thank you to all of you for a wonderful year. Merry Christmas, Happy New Year, and please spend quality time with the family and friends this holiday season. I know it's been a trying year in terms of markets, one that we've had to navigate very adeptly, and one that has been tough, but we are set up for some real opportunities coming into next year. So with that, again, thank you all so much for a wonderful year, and I'm looking forward to next year, recharging the batteries, of course, over the next couple of weeks and getting stuck back into it next year. Lots of huge opportunities coming up next year to make money. Top three things today are going to be Quad 4, so I'm just going to talk about that again because it is going to be the prevailing investment theme for the next year, I think. Rates, interest rates, that is, and finally earnings. And Quad 4, I just want to reiterate what Quad 4 entails. So Quad 4 is a declining GDP environment, so growth is falling. Interest rates typically are falling as well. We haven't yet begun that part of the movie, but it's coming next year. And then finally, inflation is typically falling as well. And again, we haven't seen that part of the movie begin yet, but we will begin to see that part of the movie really take hold next year. Inflation's still elevated, as I've discussed in other market updates, and of course, interest rates are still rising because the central bank's response to the inflation problem is, of course, to increase interest rates. So we still have a bit more of that part of the movie to play out. But I wanted to go back to the very macro level and just reiterate what a Quad 4 is all about. Typically in Quad 4, what we see is the primary things we want to be invested in are fixed income securities and the U.S. dollar. Those are two of the top performing asset classes or things that we want to be overweight in. And I thought I would start off today's run through various charts and other things with this chart of global currency volatility. Now, this is not something that I actually really followed much about or even knew for that matter until this year, which is that when currencies are typically not volatile at all. Currencies typically are the lowest volatility asset class. And I'm not talking about, squirrely currencies like the Zimbabwe dollar or whatever. I'm talking about the majors like the yen, the pound, the euro, U.S. dollar, obviously, Aussie, Kiwi, etc. And one of the things I just want to call out for you is, because you can look this chart up anywhere. This is the J.P. Morgan's global FX volatility chart. And when volatility in currency goes to the above sort of 9 in this range here, that is a very volatile environment, first of all, but it means we buy the U.S. dollar. In environments where we're sub 9, or as you can see here, you might spike up to 9, but then you have a multi-year sort of decline in volatility. That is generally when you're not going to be owning the U.S. dollar. Now, just to put this into some context, this was the period as and because this only goes back to Jan of 2020, this, of course, is the period when we had COVID really ramping up and starting. We had massive volatility in global currencies, and the U.S. dollar was very strong during that period. Entering the period into 21 and then into 22, where we had this complete regime shift in vol around global currencies when it was falling, that's when a lot of other currencies performed well against the U.S. dollar, and the U.S. dollar went down against global currencies. Fast forward to 2022, where we started to see the market begin to roll over and us entering that period of increasing interest rates and now declining growth, higher inflation, etc. We've seen global currency volatility spike again. We're above the 9 handle, and we've come down a little bit, but looking likely that we're bouncing here and going up to, who knows, it could go 15 plus this time. I don't know. But I just want to reiterate that the U.S. dollar is a primary currency holding, and then we're obviously going to be investing a bit more in U.S. equities as well. Specifically, fixed income, which is another Quad 4 asset holding, which hasn't worked. I was early, and I've said this a couple of times in these updates. I've been early on the interest rate trade. We're going to get that trade paid off over the course of the next 12 months. Unfortunately, I've had to hold the bag for that for the last 6 to 8 months, and it hasn't worked out well. Luckily, at least with the interest rate trade, you do get a coupon payment. So we've been earning the coupon, but the trade hasn't worked out yet. But it will, because the global central bank response so far to inflation has been to put rates up. And what that's going to do next year is it's going to, at some point, if we haven't started already, it's going to cause a recession, and global GDP growth, which is already beginning to roll over, is going to be declining. And the response from policymakers is going to be some sort of interest rate regime shift. And just on that note with rates, we've seen the market sort of begging for and really trying to talk the Fed into pivoting. I don't know if you've noticed that. How many of you follow mainstream media? I've stopped following mainstream financial press because they're just so full of shit, and they're just so narrative-driven, story-driven. They're not data-driven, and they're just hyping up all the time, various stocks and other things, trying to talk up their own book, and they're paid for, these people on TV are paid to spruik certain things. I mean, for any of you who might have cryptocurrencies right now and holdings in any of these exchanges that have gone bust or whatever, I feel for you. It's an area that I broadly avoided because it's just the volatility in that stuff is too high. It's not really something you would ever want to own. I shouldn't say that. It's not something you wouldn't ever want to own. You wouldn't want to own it right now with all of this volatility in it, and particularly now with FTX and the fraud and other stuff that's going on. We're just in, I think, the early stages of the blowback and blowout in the crypto space. So tread very, very carefully in there if you're thinking about allocating any capital to cryptos. I would probably wait to see what happens with Bankman-Fried and Congress and anything else that goes on out there. But having said all of that, rates next year, as I've been discussing, are going to begin to be cut, but not before the Fed and I think even the Australian Central Bank, the RBA, continue to put rates up further. So rates are going to continue to rise, and that's going to be a headwind for the market going into 2023. It's also going to be a headwind for point number 3 today, which was corporate earnings. So I've been talking a lot about this, and corporate earnings, just want to show you a quick table of corporate earnings. I've shown this before. This is S&P reported earnings. Now, we've only had 14 companies reporting thus far as of the recording of this video. And already we're seeing a pretty significant decline in earnings growth. And so this is going to play out now over the next couple of quarters. We're going to see companies revising earnings downward or pre-announcing earnings that are going to be less than stellar, and the market will have to adjust to this. This is something that I think, unfortunately, a lot of retail investors, a lot of investors out there are still banking on this idea of a Fed put, that they're going to start printing money again, and we're going to return to the heady days of S&P making new highs, Russell making new highs, NASDAQ making new highs, all this stuff. It's not going to happen. We've got a lot of market time and cycle time in between now and then, and that's going to be at a very minimum the next 6 to 9 months, or I'd say 2 to 3 quarters before we start to see some light at the end of the tunnel. And that light at the end of the tunnel, by the way, is a quad 1 or quad 2 that we will pivot to. Now, again, we have a lot of time and space between now and then. So in the meantime, what am I looking forward to next year? Well, first of all, and probably the best thing to do is just drag over our display here and just talk to a couple of key points. First of all, volatility has been in the chop bucket for the better part of the last, month to month and a half, which basically means we've been in a vol regime ranging from around 20, maybe a little less than 2019, something, up to about 25, 26 vol, even up to, as it spiked up here back in October, up to around the 30 level. And we're going to stay in that volatility range. I can't see where that's going to be coming back into the investable bucket anytime soon. Could it go up into the F bucket? Very, very possible that it could. Nevertheless, volatility will continue to move this market around, and so we'll just have to watch and wait to see what volatility does over the course of the next 6 months or so. What volatility spikes and then sell-offs do is it enables me to position and buy the things that I want to buy. And the way that works is when volatility typically is spiking, people are panicking in markets, or there's something going on where people are selling and selling the things that they have to sell. They're involuntarily selling because they bought too high and they're now selling low. But what it enables me to do is to buy the things lower that I want to own for the next 6 to 9 months. As an example of that, and I was going to say this earlier when I was talking about Quad 4, but some of the key Quad 4 asset classes that we want to own are consumer staples, gold, silver, gold and silver miners, healthcare, utilities, and real estate investment trusts. Now, I've been adding some things recently in those spaces because the economic environment that we're entering is going to be a bad one, and it's going to be bad particularly for consumers who are facing higher inflation, lower wages, higher costs of living, higher debt service. They're not going to have the money to spend on discretionary things, which is why, in particular, retail stocks. I've personally been in my own personal account been shorting a lot of retail stocks because the consumers just tapped out. But things that consumers need, so your consumer staples, these are the things that are typically better, will weather better a recessionary environment, or an environment where the economy is not going well. Healthcare, of course, is also one of those, and utilities for that matter, are one of those market sectors or asset classes that do better in recessionary environments because people need to keep the power on. They need to keep putting petrol in their car, keep heating their home with natural gas, and going to the doctor or consuming medical care. So those are a couple of the key asset classes that I'm going to continue to build positions in. At the same time, I intend to maintain a reasonable cash balance as well. It's unlikely that I will fully deploy all cash that is available in an account to be deployed. One of the reasons for that is cash, and I've said this many, many times over the years, cash is a position. And it's an important position when you realize that cash gives you infinite optionality, in that you want to own cash, a lot of cash, when there's a lot of economic uncertainty or markets are very highly leveraged and in bubble territory, which they have been for quite some time, and wait to deploy that cash, or that capital is probably even a better word to use, when you can buy assets that have been discounted heavily. So, some of you have asked me about a few different companies, some of the big companies out there. Amazon's a great example. Amazon's not going anywhere as a business, but their stock price is still too high. And it hasn't been properly, as you could say this about Microsoft, or you could say this about Meta, or any number of big companies like this, the big tech bubbly sort of companies that everybody owns, that are over-owned. And I will buy Amazon at some point because it's a secular grower, right? It will continue to grow and be profitable, and is a great company. but I just don't want to own it at this price. I'd rather own it. I don't know what the closing price was yesterday. Let's actually have a look here. The closing price of Amazon, $83. I mean, that puts the Amazon market cap at $850 billion, and it's still got a price earnings ratio of 77. The S&P 500, by example, to juxtapose this, trades at about when we have really serious market corrections, we'll get down into the single digits. I don't think Amazon's going to get to the single digits. That would be insane. But it could very well have from there, which means the stock price could have from here. Now, that's to some people, that's crazy. Like, how would that happen? Well, it's because markets continue to correct and can crash from what is already by some metrics from some people, oversold conditions. Anyway, I don't want to get too wonky and into too much stuff on this final episode of the year, except to say that there are a lot of things that I'm looking for to happen before I deploy more cash into, say, something like an Amazon or an Apple, even for that matter, or a Microsoft. But the time will come, and it's going to be, again, there's going to be more cycle time, more market time before we even get close to that happening. In the meantime, I want to position, and I have been positioning into those things like gold, silver. If you've logged into your account recently, you will have seen a few of those things. Added platinum is another one. I've started to buy a bit of lithium, not individual names, but there's an ETF called LIT, which is the lithium ETF. That's going to be, again, a secular grower, so that's a 3 to 5 year, I think, proposition. So a few things like that, and the ETFs, of course, anything that begins with an X is generally an ETF, and I'm just trying to think if there's anything else I've added recently. Gold, I think I mentioned the gold miners, the junior miners, etc. Some of those things I will trade around as well. So as things get really overpriced, I'll take a little bit of profit and buy them back. But nevertheless, the portfolio will be positioned for the market conditions that we have, and so next year, as we get into the year, I don't know what the next week or so is going to hold. I mean, right now we have a lot of people going on holidays, so volume will be very light on the exchanges. And of course, next week we'll probably have some half days and things like that on some of the exchanges. And of course, they'll be closed on the holidays. So very light time of year. They often talk about a Santa Claus rally or an end of year rally. If that happens, I don't know. We'll just have to see. But nevertheless, I love days like the one we had overnight where gold and silver got hit a little bit because the U.S. dollar started to get a bit of a bid there. And it's bounced off some of the levels that it's been at. But anyway, I don't want to get, again, too much into the weeds. So I think I'll leave it there. Again, ladies and gentlemen, thank you so much for a wonderful 2022. I am personally looking forward to 2023. I see so much opportunity on the horizon, I can't even tell you. And the confidence with which I'm entering this year as well as an investment manager and as a trader is very high. Not arrogantly high. The market's taught me some very valuable lessons over the last 3 years, both winning and losing. But I'm not going to approach this from an emotional point of view. I'm actually, over the holidays, going to be looking back over the course of the year and the mistakes that I made, and I'm going to own that because I have made mistakes. And I think the greatest travesty when you make a mistake is when you don't learn from it. And so getting the learnings from any mistake that I make is invaluable because I do actually seek perfection in this business, but it's hard to come by. As perfection is mostly in life hard to come by, it's exceptionally hard to come by in investing. So next year, again, is going to be a phenomenal year for all of us, and I look forward to it. So again, I wish you all a very Merry Christmas to you and all of your families, extended and otherwise, and please do have time off, recharge your own batteries, and try not to stress. Life is... And I'm not being preachy here, but I am also learning that life is very short. And so I do hope that you get time with all of your loved ones and family members this holiday season. And reach out if you need any support or anything else from me before the end of the year. I'll be around, not traveling, but I will be off the air until hopefully the 9th of Jan, reopening the office then. With that, I'll say Merry Christmas, Happy New Year, and see you all in 2023. Bye-bye.